Hello team, welcome to Money Zone FS Academy. Today we are going to look at the anatomy of the M and W. The tools M and W is one of the tools that market makers use to induce traders. So we are going to look critically into how market makers tend to use this structure M and W in the market and what's the purpose of the M and W. I will take you through how the build up of the M and W starts. Now for the build up we will have an impulse leg up or down. So let's say there's a build up uptrend. Then as more traders begin to enter the market, now the uptrend is meant to induce traders into placing a buy order. Okay, so as the trend is up, in a time they will pause. Now when they pause, they trigger. When they pause at a point, they get some people stuck in the market. So let's say these are buy orders. These are buy orders stacked at the top here. Now, secondly, they make a retracement. Now, this retracement will mean the whole trend is about to fall. Now, traders begin to counter trade to place a sell order here, because traders are watching. Immediately there is a push down, traders begin to place a sell when there is a downward trend, thinking that the trend has reversed. Now they make a last push towards the high, towards this high here of the previous leg of the M. So when they make this leg up, now there is two things involved here. Okay, the buyers and the sellers have been jammed here. When they push up, the sellers go into negative and the buyers also be in negative, because the buyers were stuck here and the sellers were stuck here. So in between here, price becomes stagnant here, or they relax in the middle here. Now the reason why they relax is to cause a lot of people to place more trade. Now those who place sell here will begin putting their stop losses around here. So all stop losses will be placed here. All the people placing a sell order, all their stop losses will be placed here. Now for market makers to go down, they need to clear all the stop losses so that if they are coming down, they will not lose much money. Okay, so anytime, the concept is anytime you place a buy, market makers place a sell against your buy. So when you win trade, they pay you. When you lose trade, your money goes to them. So they induce more traders and then cause more people to place a trade, commit you to place a trade. They trick you to go into the wrong direction and then they take your money. So here, people place stop losses above this high. So for them to come down, they need to clear all the stop losses, because people have placed a sell order here, and when they are coming down, these people would intend to make a lot of profit. So to cut the number short, what they do is they go up a little and then come down. They do this with a pin bar like this, or they use two candlesticks to achieve that. Immediately they pick the orders, they come down to where they are going, their true trend. Now, the structure again is built up like this. Now, and this is a pin bar. They use the pin bar to trigger all the stop losses placed above this leg. So now when they take out all the stop losses, because before they come down, they need to take all the stop losses, and people place stop losses above here in this area. So they make an up move, go above this leg to clear all the stop losses, clear all the sellers from the market, then they come down, right? So now let's go to the market, and then we see how that is being played out. Okay, so this is a typical M. Okay, we have this to be an impulse leg, and then we stopped here. We have this to be an impulse leg, so this is an impulse leg. So this is where traders jumped in. Traders are jumped in at this level. Trade will push down. Now when they go up, the market makers' intention is to come down at the end of the day. So for them to achieve that and not to lose enough money, traders, market makers push trade. Now all the people that place sell will put their stop loss here. People put their stop losses here. Now for market makers to come down, they need to clear the stop losses that have been placed around here. So they go up, they clear the stop loss, and this is the stop loss. This candle was used to clear the stop loss and clear all the sellers from the market before they came down. So the setup, this is how the M setup built, and this is the objective of the M and W. Market makers go up, induce more traders to enter buy. They pull up, down, cause a lot of people or cause a lot of buyers to get jumped in the market. They go up to clear the stop loss of the sellers that are in the market, so that they won't lose much money when they are coming down, and then boom, they come down. So a typical M, if you see a pin bar on the second leg, that is a confirmation that you are looking at a very good M or W signal, right? Let's look at another secondly, let's look at another M. Okay, now there is a push up here. Now this setup was used to jump buyers. Now a lot of buyers have been jumped here. They make a pullback. Now look at this carefully. You will realize that this leg didn't go above here. Now this can be interpreted, or this means that there are a lot of traders jumped here, around here, and if market or price goes beyond this, it is going to release a lot of the buyer from the market. So instead of clearing the stop loss, they realize that okay, this could be a reason. Maybe there are no much sellers in the market, therefore there are no stop loss above this to clear. So they come, they create a movement as if they are going up, and then boom, they come down. Now there is 2M. Okay, you can have an M build up like this, and then you can also have an M build up like this. Now this type of M has two different meanings. Here, the first M here, this is used to clear a stop loss from the market. And here, now traders got jumped here, and market or price don't need to go here. The moment price go into this area, it is going to release a lot of traders to come out of the market. Now remember, this is a game between you and market makers. Market makers need your money, and you also need their money. So you got to be very, very, very careful and follow the rules of the market. Don't trade because you have money to trade. Trade because you have a reason to place a trade. And don't trade against market makers. Trade along with what market makers are doing. That is just an advice to you. Okay. Somebody will ask, how will I trade the M&W? Now, this is how to trade the M&W if you spot one in the market. Now, there's an impulse leg. You see a move down, and then you see a move up, and you see the market dropping. Now, at this point, at this level, do not place a sell. Okay, do not place a sell, because market can continue going up like this. You may not know. What makes M valid is its neckline. So what is the neckline? So you have an M like this. Here is the neckline. This is the neckline, and it's a solid zone. So when you see something like this, you have to wait for what we call a retest, and then I will cover the retest in subsequent sessions. So when market breaks the neckline, wait for market to retrace back into the neckline. So you see this. When you see market break the neckline, come back to test the neckline. That is your entry point to sell. Boom, you see this dropping. Right? Let's take that one more time. Let's say we have a W like this. W is not complete unless we have a neckline, unless the second line breaks the neckline. Now, do not be in a haste to trade or place a trade with this. Wait patiently for market to go and test the neckline. Now, when the test is done, that is your entry point to place your sell. That's your entry point to place your sell. When you place your sell, we expect markets to go down like this. So this is the point, your entry point. This is where you are supposed to start your trading. Okay? Again, now we have looked at our entry point. What about stop loss and then take profit level? Wow, okay, we have our M drawn nicely like this. We have our neckline drawn, which is a zone, and you place a sell. You place a sell here, and then market goes down. At what point should you come out of the market? Now you calculate the distance here, the distance here to here, and you trade the same distance from here to here. Sometimes it can go deeper, but for you to be secured, this is your take profit point. You measure from the M structure and then you drag it below. The same length here have to be the same length here. Okay? And so this becomes your take profit level, and your stop loss will go above the first leg. Now it should be 15 to 20 pips ahead or higher than the second leg, because market can come back to that same level to pick or hunt for stop losses again. So let's say we have M structure like this. We see the neckline. Market goes back to test the neckline, and then we place our sell order. Now our take profit, this length here will mean our take profit. So the same length here should be the same length here for you to take your profit, and your stop loss should be placed 15 to 20 pips above the second leg. Right. So let's go into the markets and see how this is placed out in the market. Okay, so we have an M structure here. So this is our neckline here. Now you draw the neckline very well. So you take the wick. So where the wick are formed. Okay, so the neckline have to be the wick. Now we have a push up like this, have a push down. The second leg forms, and then we see a drop. Now when this is dropping, don't panic or don't rush to enter the market. Wait for a retracement. It will have to retrace to retest the neckline, and that should be your entry point. When you see a test on the neckline, this should be your entry point to place a sell. Okay, so to measure how far this will go, your take profit, take from here to here and measure from this point to this point. So your take profit will be here, right? And you could see this is a very strong support and resistance level, so it is advisable to take your first take profit from this level, and you could see how market reacted to that level, right? And your stop loss should go 15 minutes above the M, 15 pips, 15 to 20 pips above the M. Yes. So this is how the M is being traded. The same thing we are doing on the M is the same thing you will see on the W. Let's see if we see another. Okay, we see okay, let's see this structure. We have our impulse leg, and then we have the neckline of the M. Okay, you have a drop, have a push up, and we see a drop here. Now when you see it falling, do not change it. It will by all means retrace. Now it went back to do a retest on the zone, and that should be your entry point. Every valid M and W, there should be a retest on the neckline, and your take profit is from here to here. That same distance should be your take profit level. So your take profit level will be here. You are supposed to take profits at this level, right? So guys, that is the M and then W. That is how you can trade the M and W. If you have any question, okay, I think we have another one. We have our neckline. We have our neckline here. have our impulse leg up, down, second leg formed, and we see a drop, and again you see it coming back. Don't be in a rush to place your trade. Wait for a retest to form, then you place your sell. Your entry point, this should be your entry point, right? So that is how you trade the M and W. The same way you trade the M is the same analysis you will use to trade the W. So it is the same thing. So if you have any question, if you have anything to show, if you have anything bothering your mind on this particular topic, let me know and I'll address that and look at it for you. So I'll meet you in my next video. Thank you.